listen, I'll be the first to admit, like, I struggle with this. There's tension that I feel in. Investing is easy. It's never been easier. And investing is really freaking hard.
Yeah.
And it's just as hard as it's ever been, if not harder.
All thoughts and opinions shared in this recording belong to the participants. This podcast is meant to inform and educate and should not be seen as solicitation or endorsement for business.
Welcome to the Market Moment. This is Matt here with Lee today.
Good morning.
And we've got a couple topics we want to talk about, just the two of us. A lot going on here at the office, so just me and Lee this morning. But glad you guys are joining us. So a lot going on in the world. Had Trump come out, and a lot of conversation around Greenland. He's in Switzerland today and tomorrow. Markets reacted yesterday. Big down day in the market. Most of the major indexes were down. 1.5% to 2.5%. Market's kind of bouncing this morning because everybody's like, "Hey, Trump's not gonna invade Greenland."
Yeah.
So that's kind of front and center. Any quick thoughts on that?
It was interesting in that, we had a pretty sell America theme yesterday. America stock sold off. The dollar sold off. U.S. Treasury sold off. Bitcoin, crypto sold off. So it was a very anti-American sentiment, which was interesting because probably 2/3 of the decline occurred before 10:30, 11 o'clock when Europe closes.
Right.
Once Europe closed, we stabilized a little bit. And, we did trend down a little bit towards the end of the day. But it was a very negative sentiment towards the U.S. Interesting in that as the Fed has lowered rates here domestically, when the world sells treasuries, it causes overall interest rates to go up. Mortgage rates are directly tied to the 10-year, which they saw a spike yesterday. So, things are kind of settling down a little bit today, like to your point.
Yeah.
We had a long weekend. A lot of this negative news came out over the weekend. You had a lot of pent up negativity, and you see that, and you see it on the flip side too in positive times. But everybody had 3 days to stew on this, and they came in on Tuesday morning and sold.
Yeah.
So calmer heads will prevail. This Greenland issue, as you and I were talking before we went on camera, is nothing new.
It's not new, and it's more complicated than people, it's not this whole idea of like Trump just wants to take Greenland.
Correct. Correct. To add to his real estate portfolio. Yeah. This is something that has come up probably for the last 150 years. Multiple presidents have discussed it, made the attempt to, never been successful.
Right.
But to your point that you were making earlier off camera, Trump is a pretty good negotiator. And, one of the things that he does at times is he shoots for the moon knowing that he's going to have to settle for something between here and there. So it'll be interesting to see how it plays out. Europe's involved. What really caused the markets to sell off was the threat of more tariffs on Europe if they didn't get behind his plan.
Right.
So,
yeah, you have to keep a cool head through a lot of this, right? Just kind of stay calm. I think the markets reacting the way they did wasn't surprising, and it's kind of encouraging. It's like, okay, like big negative news, big potential negative outcome, markets reacted appropriately.
Yeah.
That's never a bad thing to see as long as things kind of settle out and people don't panic.
And
right? It's the panic that you want to avoid. Having 1 or 2 days of a sell-off because of a major headline and it's kind of, okay, let's reset and see where this goes. I think it's good to see the market not doing, the opposite of like, there was a couple years ago, it was like the market was rallying anytime there was bad news because of all the nuances. And so,
and it reminds you how far we've come how high we've run in the market in that, we had an 800 plus point sell-off and that wasn't but 1.5% or, 1.
Took us back to like January 3rd.
Yeah. And so it reminds us, man, we've had some years of great returns. This is, normal. Doesn't feel good, but it's normal.
Yeah.
And then things will resume. It's normal, like you said. Bad news, bad results.
Yeah.
So.
And so along those lines, like talking about geopolitical issues and things going on around in the world. We were talking about, and this isn't maybe as defined of a topic as we usually talk about, but just kind of more of a conversation around how, there's this tension in investing that, let me take a step back. I think any time in life where you go too extreme to the side, right, to either side, you either overcomplicate or oversimplify something. There's risk in that, right? And usually truth and reality lies somewhere in the middle. And I think it's no different, when it comes to investing. A lot of people try to way overcomplicate investing, right? They try to get too cute, right? You can get yourself hurt there, financially speaking. A lot of other people try to way oversimplify, right? And say, hey, it's this easy, which you can get hurt and get burned, financially speaking. And reality, in my opinion, lies somewhere in the middle. Investing, access, I think there's two different things people are meaning when they say, hey, investing today is easy. The access to investments and making those investments has never been easier and is getting easier by the month almost, it seems like, right, with innovation and technology and new products. So access to investing and making investments has never been easier. We've seen that in the private market space where you could do that easier than ever. But managing those investments, knowing which investments to make, what you should own, what you shouldn't own, is not easy, right? There's a lot that goes into that. Most people's goal should not just be like, how do I get the highest return possible? Because their financial life is way more complicated than that, and they have short-term needs and mid-term needs. It's we kind of deal with this on a daily and weekly basis when we're putting together client portfolios and client plans on, hey, it's not as easy as just throwing everything you've got in one bucket and letting it do what it's going to do, because life happens. Things don't do what we expect them to do, or don't do what they've done historically. And so you have to be prepared for that ahead of time. So what are your thoughts on that when you think about investing being easy in terms of access and making investments, but still being hard and difficult to stick with it and have the right things in your portfolio?
It's the emotional side of it. Nobody invests in a vacuum. The access to resources and products and solutions is, like you said, it's easier than it ever has been. Within probably 10 minutes, you could open an investment account on your phone and tie your bank account to it and have money ready to invest. I think another component to that is, if we polled 100 people on the street, what's the most common index? Benchmark. 95 of them would say the S&P 500. And so we see a lot of people in the office that automatically will come in and say, well, the S&P 500 returned 20% last year. How did my investments do? And so it's, the access to investing is easy, but I think the education of what is, how am I doing? It's not a absolute number. They want it to be, but most people, the majority of investors, the S&P 500 is not the appropriate benchmark alone to tie their investments to. It's tough because when you talk to other people at the club, at the grocery store, at church, in your neighborhood, everybody wants to compare returns. Well, I returned this amount, and
it's hard to say that coming out of because the S&P has outperformed for a long time now, right? Going back 15 years, it has kind of been the behemoth from a performance standpoint globally, right? U.S. large cap technology specifically, but U.S. large cap stocks have outperformed. Last year they didn't, right? International, we've seen some small cap, kind of rallies here, short in the recent history. So other parts of the market, other parts of the world have started to kind of rebound. Peter Mallouk, CEO of Creative Planning, posted on Facebook or LinkedIn, S&P 500 rolling 5-year total returns, and we're coming off of 15 years rolling out performance for the S&P 500 minus the MSCI World ex-US. It's the longest in history. If you go back to from like 90 through the early 2000s, from 90 to about 2002, there was a 12-year rolling period of outperformance. but then it, underperformed from 2002 through 2010, 9, 10. And you can kind of see that. Like there's times where international and other parts of the world and other parts of the market do outperform for extended periods of time. And we've been in a 15-year cycle where that hasn't been the case. And so it's human nature to assume it's like, well, this is the new normal. This is how it's always going to be. It's not. It's likely not going to be. And your portfolio should probably not reflect, 100% U.S. large cap.
Absolutely. And most of the people that we work with do not need 100% large cap growth.
Well, and why? Because you want for risk management,
sure,
right? For diversification, right? And trying to maximize returns relative to the risk that you're willing to take. So risk-adjusted returns. What was the quote we were talking about earlier from Warren Buffett? He says, I think this is such a good quote, and it can be, investors, markets are driven by fear and greed. And oftentimes, whether we want to admit it or not, we are caught in the camp of greed, wanting the most or wanting the more returns. But when you read it, when you hear this quote, it kind of makes you take a step back.
Warren Buffett's one of his core messages on money is never risk what you have and need for what you don't have and don't need.
Mm-hmm.
Sure.
I think that's a great perspective, and that's talking about someone that has assets.
Yeah.
Right. If you don't have assets, you're just getting started, then you're not in that camp because you're just trying to build and get to the point where you have what you need. But when you get there, right, like a lot of our clients are, you get to that point where you have the assets you need. Like you're in a pretty good spot. Now, like it or not, for most people, like your investing philosophy should evolve and change over time.
Sure.
And
one of the one of the things that is frustrating at times, and I'm going back to this benchmarking, is most of the families that we work with, the S&P 500 is not the most appropriate benchmark for their portfolio. And they'll ask that.
Right.
But oftentimes reports that
that's the standard.
That's the standard, clients up 10.5%, S&P 500, same time period, 18. Well, they immediately come in and think, well, man, I'm really underperforming. Well, you are, but, the appropriate benchmark for your portfolio is probably a very blended portfolio that includes international, fixed income, small and mid cap. So it's an education, an educational component to what we do.
Yeah. And I don't know what the ultimate thing we're trying to communicate there is, other than just, we talk about planning a lot on the podcast. That's what we spend a vast majority of our time doing here at the firm. And, it's going back to that. What is your plan? What do you need? What do you want? Right. If it's just investing for the sake of having more and there's no definition or goals around that, maybe you should go buy the S&P 500.
Yeah.
Right. And just let it ride and hope that it does continue to outperform. But most people have goals, have, a relationship with risk that is not 100% like, hey, I'm willing to be as, super, super risky. Most people aren't comfortable with that. And so, introducing these other investments that play a key part in building a diversified portfolio, it's necessary and it's good, but it does complicate things when you're trying to figure out, how should I be doing?
Yeah.
And how am I doing relative to what that should look like?
And you get to a point too with investing where, the benchmarks aren't that important. You get to a point where you're not having to hit double-digit returns every year.
Mm-hmm.
You've reached a point where, I'm very comfortable getting 5 to 7. No matter what the markets do, you're not assuming more risk because you've planned. You've hit those goals. So it's an educational piece. I was just thinking while you're saying that, even our most aggressive families that we work with are not in 100% large cap growth.
Yeah.
I mean, they're just not. But if you're I was talking to a young couple yesterday. I mean, early 20s. I mean, go be aggressive, you
Yeah.
know, and for somebody like that who is just starting out, buying an S&P 500 index fund, you know, may make some sense. But
Yeah.
when you really get into planning and working on retirement goals and so forth, it does require more diversification, and then the S&P 500 is not the most appropriate benchmark.
Yeah, and I think the moral, kind of not the moral, but just kind of the takeaway from the conversation. And listen, I'll be the first to admit, like, I struggle with this. There's tension that I feel in. Investing is easy. It's never been easier, and investing is really freaking hard.
Yeah.
And it's just as hard as it's ever been, if not harder, because of the way markets react and then the news flow. And it's great. It makes things, you know, it gives us, we all have access to the same information for the most part, and we have access to it very quickly, which is great. But not letting yourself get caught up in the noise and these knee-jerk reactions that you can see complicates things.
You know,
can make it harder.
You said the word noise, and that was the first thing that came to mind was, yes, it's easy, but man, there's a lot of noise out there. And, you know, we live in a headline-driven society. You know, you're getting headlines on your phone. You're getting them, seems like there's always a red scroll going across Fox News or CNN or CNBC. And, you know, it's not all breaking news, but.
And our space our industry has changed so much. You know, if you look back 20, 25, 30 years ago, it's like people worked with a financial advisor for that access, right?
Yeah.
You essentially had to. Like, if you wanted to make these investments, you had to go find someone who was able to offer or sell those to you, right? Not necessarily the case today. So we're almost in that, like, financial counselor kind of role of, like, hey, we're going to allocate appropriately. You don't need us to get access to these investments for the most part. But you need our team and our expertise on how to allocate. But then you need our counsel on the planning, the tax component, the sticking with it, the not reacting to the noise, you know. And so it's super interesting to see how the industry has evolved. And when we look back in 5 years, 10 years, how much more it's going to evolve because of AI, right? And how much more that's going to be true of, like, people needing someone to not get access to something, but help them manage that well, whatever it is.
I've said it before on this podcast, but, you know, investment conferences have evolved over the last 10, 15, 20 years. You know, it used to be very product driven, very product heavy. Here's ways to invest. Those are much less now, and there's more and more sessions on psychology.
Yeah.
The emotion of investing. And so, I'll tell people that we work with is, investments in and of themselves are a commodity. I mean, you can go buy stock on your phone for free, on some of these online portals. So what do you need us for? I mean, it's to hold their hand. It's to do the planning. It's to walk them back from the cliff when the market is sold off 10%. So it's evolving. AI is going to continue to change it, but there's always going to be a need for humans.
Yeah.
For that impact right there.
Yeah, we heard in Orlando at the conference we were at. Zach Cass has a book out there. I just got it in last night. Actually, going to start reading it. But the AI Renaissance, I think is it's called.
Yeah.
But he really gets into how AI is going to change healthcare, education, finance, the markets, all of these things. But how that should, if we manage it well, lead us to more of a human touch, human interaction where people actually need each other more. Just maybe in a slightly different way.
Yeah.
So looking forward to diving into that. But any other thoughts, anything else going on that you want to touch on before we wrap up?
Good conversation.
Yeah, it'll be interesting to see kind of headlines coming out of Davos over the next 24, 48 hours.
Davos has always intrigued me. It's the one time of year and the one location where literally you have the top economic leaders, top business leaders, and the top political leaders in the world in one tiny little town for a week. There's been some big things come out of Davos. President Trump was speaking as we came on the podcast this morning. So I'm sure there'll be some headlines from his talk. Oh, yeah. So it'll be interesting to see.
Yeah, for sure. Well, as always, we appreciate you guys watching and listening. Give us a like, subscribe. Check out Eli's data brief that he consistently puts out every other week. He's doing a great job with that. I know he really has a lot of fun with it and covers a lot of great information, so be sure to check that out. Thanks for joining. We'll see you guys next week.
The hosts of the Market Moment podcast are employees of Mach 1 Financial Group, LLC. Mach 1 is a registered investment advisor located in Rogers, Arkansas. A copy of Mach 1's current written disclosure brochure is available through the SEC website and available at disclosures.mach1fg.com.